Tonight, the gold to silver ratio didn't just drift lower, it snapped. That sudden move is the entire reason this conversation matters. In the final stretch of trading, silver strength accelerated enough to drag the ratio down at a speed that caught most people off guard. Single-digit ratios are no longer a joke tossed around on forums or social media. They have moved into the realm of a real, active scenario. And if that scenario continues to unfold, the market is not bracing for an ordinary uptrend. It is bracing for a full repricing event. What actually happened is simple but powerful. Silver shifted into a higher gear. The ratio began compressing, and the discussion quietly changed from whether silver was moving at all to how far it could outrun gold before the broader crowd noticed. That moment matters because once the crowd notices, the move often changes its personality. It gets louder, faster, and far less forgiving. Calm trends turn emotional. Orderly price action turns chaotic. That is usually when mistakes are made and fortunes are either accelerated or destroyed. Before going further, a quick pause. There is an ongoing effort to protect original analysis from copycat channels that recycle content and confuse new viewers. If you value this work, subscribing and dropping a comment helps separate real supporters from noise. A surprising number of people watch regularly without subscribing, and while that's understandable, one simple tap actually makes a meaningful difference in keeping this going. To stay even closer to the action, there is also a WhatsApp channel where daily updates are shared. Quick notes go out when the market flips, and links are posted so key moments aren't missed. It's designed to keep things simple and keep you ahead of the headlines. Now back to the core issue. Why is everyone suddenly whispering about a 7-to-1 ratio like it's some kind of countdown clock? Because the gold to silver ratio isn't just another line on a chart. It's a pressure gauge. When it falls, it means silver is outperforming gold. When it falls sharply, it usually means silver isn't merely participating in the move, it's leading it. Most people think of silver as a cheaper version of gold, a smaller sibling that just tags along. In reality, silver behaves very differently. Gold supply is mostly gold supply. It's mined because people want gold. Silver supply is far stranger. A large portion of global silver production doesn't exist because someone set out to mine silver specifically. It exists because miners were after copper, lead, zinc, and other base metals, and silver came along as a byproduct. That one detail changes the entire equation. If silver demand suddenly surges, the industry cannot simply flip a switch and flood the market with new supply. Most production is chained to the economics of other metals. Even if silver prices explode, the supply response is slow, messy, and limited. When supply can't respond, price becomes the release valve. This is why collapses in the ratio can be so violent. The ratio doesn't just measure relative value. It measures stress in availability, stress in sentiment, and stress in positioning. When the market senses tightening silver conditions while gold remains strong, the ratio can compress faster than most people can emotionally handle. A lot of you are probably asking whether it's already too late. That question usually means you're watching the wrong scoreboard. Late for the very first leg, perhaps. Late for the entire move, not necessarily. Parabolic markets don't reward participants evenly. They pay out in bursts. Early on, the move feels slow, boring, and frustrating. Then something flips, and the same price action that tested your patience suddenly starts sprinting. That's the law of the parabola in plain language. As trends mature, returns compress into shorter windows of time. When that happens, your biggest enemy isn't the market. It's your own impulse to chase at exactly the wrong moment. This leads to a hard truth most people don't like to hear. The closer the market gets to major milestones, the more dangerous leverage becomes. Not because the long-term idea is wrong, but because the path gets rougher. Pullbacks get sharper, fake breakdowns get more convincing, and leveraged positions can be wiped out even while the larger trend stays intact. A smarter framework is to treat this like a campaign, not a lottery ticket. Hold a core position you can emotionally survive through volatility, and use a tactical layer for adding on pullbacks and trimming into sharp rips. That way you're not all in emotionally and not completely out when the move continues. You're managing risk while staying exposed. The obsession with single-digit ratios creates so much heat for a reason. When the ratio drops into single digits, the narrative changes. Debate fades and attention spikes. When enough people start watching at the same time, markets often overshoot. Overshoots are where headlines are made. That's where silver can run far beyond what feels reasonable, not because it will stay there forever, but because momentum, scarcity anxiety, and positioning stress collide. People insist it can't reach 7, then it reaches 7. They say 5 is impossible, then it taps 5. It rarely lives there, but just touching those levels can shake the entire system. There's another layer that makes this environment especially dangerous for casual investors. As soon as silver starts outperforming, familiar stories get pushed aggressively. You'll hear that it's the top, that it's a bubble, that this is the last chance to escape. Parabolic moves can end violently, but notice when those warnings usually appear. They tend to get loud right when everyday people finally start paying attention. Fear is the easiest tool for shaking weak hands. Markets follow a familiar sequence. When an asset is quiet, nobody talks about it. When it starts moving, coverage appears. When it starts making people money, warning articles flood in. When it becomes obvious, volatility explodes. That's why it's critical not to trade headlines, but to trade structure. Structure is what separates real trends from fake ones. A real trend holds higher lows, recovers quickly after dips, and keeps reclaiming key levels. A fake trend spikes and then bleeds for weeks. If you want the cleanest signal for what comes next, watch what happens after the next pullback. That pullback, whenever it arrives, will answer a lot of questions. If silver dips and is immediately bought, that tells you demand is impatient. Impatient demand usually means a tight market, and tight markets don't offer many second chances. If silver dips and the bounce is weak, that suggests demand is cautious, and the market may need more time before the next leg higher. Either way, the dip is information. Treat it as a message, not a betrayal. It's also important not to ignore the paper market games that show up during stressed phases. Sudden sell waves often appear at the worst possible moments, designed to maximize doubt and emotional selling. The goal is simple: force people out, then let price recover once the panic has done its job. Acknowledging that this happens doesn't make you paranoid. It makes you prepared. A useful rule to live by is to assume the next few weeks will be messy. Assume there will be at least one move specifically designed to scare you. If you plan for that, it won't shock you when it happens. And if you're not shocked, you're much harder to manipulate. Now comes the real cliffhanger. What happens when the ratio cracks a level everyone is watching? Once a level becomes obvious, it turns into a magnet. Traders pile in, stops cluster, and liquidity hunts begin. The market usually does something dramatic there, either a violent continuation or a violent shakeout. That moment separates prepared participants from hopeful ones. So if you're watching levels like 9, 8, or 7, don't just watch the number. Watch the reaction. Does it slice through without hesitation? Does it tag the level and snap back? Does it churn around it while momentum stays hot? Those micro reactions are the fingerprints of what comes next. Another critical piece is industrial demand. Silver isn't just an investment metal. It's used and consumed. It's built into products and scattered across supply chains. That means above-ground silver isn't as available as many assume. Some of it is locked into goods, some is dispersed, and some is uneconomic to recover quickly. Gold, by contrast, is mostly hoarded and stored. When investor demand rises while industrial demand stays firm, silver can tighten rapidly. And when it tightens, price doesn't adjust politely. It can gap, spike, and overshoot. Consider this scenario. A slowing economy reduces base metal production, which quietly tightens silver supply, while monetary anxiety boosts investment demand for silver at the same time. Supply responds slowly. Demand moves fast. That mismatch is where explosive moves come from. This is how extreme price conversations even begin, not because anyone can guarantee them or should anchor their life to a specific number, but because stressed markets can overshoot in ways that feel unreal. Responsibility matters here. If the market enters a melt-up phase, the correct posture changes. Early phases are about accumulation. Melt-up phases are about risk management. That means trimming leverage, tightening plans, and protecting gains already earned. The goal is to stay in the game, not to brag about never taking profit. People often ask why everyone doesn't pile in if it's so obvious. The answer is simple. The journey is brutal. Silver rarely moves in a straight line. It behaves like a coiled spring, popping, snapping back, then popping harder. Most participants buy the pop and sell the snapback, then watch the next surge from the sidelines. Discipline sounds simple, but is hard to execute. Decide what you're willing to hold through noise. Decide what you'll actively trade. And don't mix those identities in a panic, because the market will charge you tuition for confusion. In practical terms, ratio collapses usually happen in one of two ways. Either gold falls while silver holds, or silver rises while gold holds. The second scenario is far more explosive for silver because it means both metals are strong, but silver is stronger. In that environment, silver can feel like it's teleporting higher. That's when conversations shift from normal targets to historical extremes, not because the market is trying to be dramatic, but because it's searching for equilibrium under new pressures. If consolidation shows up, pay attention to its character. Does price dump and stay weak, or does it dip and get bought almost instantly? Fast buying signals hungry demand. Slow, hesitant buying signals exhaustion. The tape will tell you which one you're dealing with if you're willing to watch it calmly. For anyone feeling overwhelmed, this matters most. You don't need perfect timing. You need a plan that survives volatility. You need position sizing that lets you sleep. You need rules that stop you from doing something reckless on a random red day. The biggest risk isn't that silver never goes higher. The biggest risk is that silver goes higher in a way that knocks you out before the main move because you chased, over-leveraged, and panicked on the first sharp pullback. Staying rational is the edge. Build exposure in layers. Keep dry powder if you plan to add. Protect your core if you're already up. And don't let a single candle convince you the story is over. Markets don't end because of one bad day. They end when structure breaks and demand disappears. When you step back, the logic forms a clean chain. Silver supply is inelastic because it's mostly a byproduct. Demand can surge from both investors and industry. Parabolic trends compress returns into short, violent bursts. Major milestones often trigger pauses, not endings. And the gold to silver ratio is the scoreboard that tells you whether silver is truly leading. What matters next is whether the ratio keeps compressing towards single digits, whether silver holds key support during any rest, and whether dips continue to be bought aggressively. If those conditions remain intact, the next leg can still surprise people who think the move is already finished. If the ratio really is collapsing back towards 7-1, the next chapter won't whisper. It will move fast, and it will reward preparation over emotion. So the real question is simple. Are you positioned? Are you waiting patiently for a pullback? Or are you still on the sidelines watching it unfold?